Happy Tuesday, happy time, Rodney. How are you?
I'm doing fantastic. How are you, Andy?
I'm
I
just,
forgot. I
I'm
was supposed to
good.
call you Dandy. I don't know what.
Dandy is good. I'll answer to that. Good morning, Ange. How are you, young lady, our California friend? Rodney, I'm going to say I noticed that you've got a bit of a glow going, a little bit of a tan, I think I sense.
Well, I was trying, but I couldn't find her. I was in Palm Springs for the weekend, played a little golf, had a great trip. That's just amazing area down there. I love that. I love California. So it's a
I do
cool
too.
state.
I'll tell you, of all the people, I catch a little flack, but if I could, I'd live there. Every time I got off the plane in California, it's like, oh, this is good.
Man, just something about palm trees. I think Georgia, maybe somewhere in Georgia, is the furthest north palm trees will grow.
Aha. Huh.
I don't know
Well,
about that. I'm not but
but so life is pretty good. Going to Palm Springs golfing. I didn't happen to make that trip, so I held down the fort here.
thank you.
And there's a lot of stuff going on. Today's election day, so there's voting going on, and I think another jobs report's coming out this week. There's some financial stuff happening this week.
Yes.
Mm-hmm. So we're going to be talking about that, but we're going to get started with. First, I wanted to say, my name is Andy Elliott. I'm a realtor here in Williamson County. I'm with Rodney, and he is Rodney Wilds, and he's with First Trust here also in Williamson County. And we have a special guest coming up here in a few minutes. Also he's Franklin now, so I'm not sure what his zip code is, but he's in our area. Jay Alexander with Chapman and Rosenthal Title. Good friend, long time. We're going to talk about title insurance and Fannie Mae and what they're trying to do. But before that happens, we're going to do this like we all know it's coming. Here we go.
Well, look at this. This is on a 6-month view, and it looks like today this green is good, red is bad, and when they go higher on the chart, it means the rates are going down. It's kind of backwards. But what you're looking at is I'm still kind of right back in here in October, mid-October. We made some significant gains, and then it's kind of been cut back down. But we're still in the December level of early December level of where the rates are today, and hopefully maybe poised to see it's bouncing off this floor here, this line right there. It's kind of kept this rate right here. Maybe we see some improvements, but overall it's still a lot better than it was back in October, which is in the long haul, this hopefully trend may see it kind of going down, maybe curving back up right now. So that's what we're hoping for.
And I tell you, and it seems like we're pretty consistent with this, that Rodney always takes the long view, as well he should. And I tend to look at today's rates. So if there was panic to be had, it would be on my side of the fence. And I know a few days ago, it was like 713 or something like that. This is average, it doesn't apply to everybody. But the average was 713 or something. And now today it's down to 703 or something. So, I mean, even now it's still bouncing around pretty good.
Yeah, I mean, and that's 10 basis points, and that's about what that represents right here over the last, few days that we've seen just a small trend upward, which is, I'll take steady or upward.
Steady or upwards. That's good. All right. So things are looking up. And so today what we're going to do is we're going to touch on affordability. It seems like, that is such a hot topic, affordability, because it needs to be addressed. Nobody seems to quite know how to do it. And today we're just going to talk around the edges, the way I like to say, around a particular topic of affordability. Some of it, we're going to talk a little bit about the national stuff, and then something they're trying to do. I always try to bring it home here. They're trying to do something here in Nashville that is important to the three of us, to Jay, Rodney, and I. But my question is, well, you'll see how my question rolls on that. I wonder how that's going to go. So let's go with this part of the program. Love that. Here we are. Look who's a man in the middle. Jay Alexander.
The man in the middle.
How you doing?
I'm doing all right. Happy to be on here with you.
Hey, thank you, Jay. Thank you. We haven't had our glitch in the program yet, so it's coming. It's still coming, like Rodney always says. So first, I want to say, again, this is Jay Alexander with Chapman and Rosenthal Title. If you have questions about title insurance and all that sort of thing, whatever that involves, if you're going through the purchase process, I will, with Jay's good graces, I'll leave his contact information in the description box with Rodney's in mind. That's what we're here for, is to help. If you have questions, call, text, or email, and you can get answers to your questions. Kind of doesn't matter where you're coming from. It might, but initially give us a call. So is that fair, Jay?
That sounds great to me.
Okay. All right. And so here's one of the things that we were talking about. I'm going to see if this works. This could be check test. Here we go. Oh, it did work. This article is about improving housing affordability without exposing home buyers to more risk. And although the title really wouldn't tell you much, what they're doing is trying to address affordability. And in this particular article, they're attacking it from reducing fees, which makes sense, but we'll talk about that. So it's no secret that a housing affordability challenge in the USA, according to NAR, National Association of Realtors, since the spring of last year, the typical family with a median income have not been able to afford a median priced home. While mortgage rates will likely fall this year, conversations about how to increase accessibility to home ownership are still top of mind. So any proposal to increase access to home ownership and improve affordability should be evidence-based, sustainable, meaning avoid quick fixes, and not come at the cost of consumer protection, which is the point of this article. So my first question to Jay, and we've worked together for 10 years, full disclosure. I consider this three of us a team, at least for me. What is title insurance? I don't want to say exactly, but can you explain title insurance?
Yes. So kind of not getting too far into the nitty gritty, but what title insurance does is it ensures that you, as the buyer, are property that you think you're going to purchase, that there's no liens on the property that are outstanding. The seller's mortgage is getting paid off. The seller actually is the person that can sign the deed to convey you the property. So it ensures that what you're purchasing is actually going to be yours, and that you're going to own it, maybe with your own mortgage on it, or outright if the title insurance policy guarantees.
Okay. And so that also includes things like mechanics liens and stuff like that, right?
Right. So that stuff, that's part of the title policy, that the title company can research that, check all those things, and make sure those are taken care of as well.
And this is all done through public records and research and that sort of thing. Is that correct?
Correct. Public records, for the most part, and not to get ahead, but there are some other things, like if there's an estate involved, then you may be researching some court records or affidavits or wills that may not record in the Register of Deeds office, but you use that information then to determine who owns what and who can sign on behalf of the seller. And
so here's a tough question. is it required? Is title insurance required?
So owner's title insurance is an optional item. The buyer can choose not to purchase it. If they are getting a loan, they do have to get a lender's title insurance policy, and that is required. And so the nice part, if you're already getting that policy, there's what's called simultaneous issue that allows you to purchase an owner's policy at a reduced rate. Or you buy the owner's policy at the full price, and then you get a loan policy for $200 instead of having to pay the premium twice.
And there's also a thing, boy, Rodney, sorry, I'm just steamrolling you here, man. Is there a thing called an enhanced policy as well?
Yes, there is an enhanced title policy that usually costs about 10% more than a standard title insurance policy, but it does have some extra coverages. It can cover things like encroachments on the property, if there are some that need to be moved. It can even cover the removal of some of those. Some of those do have a deductible with them, but it also, the enhanced policy will increase in value over time. So where if you purchased a home for $450,000 today and got a title policy for $450,000, the max that policy would pay out is $450,000. But an enhanced policy, I believe, can go up 10% in value each year, up to the actual value of the property, but it can increase. So when we are in a period where home values are going up, that can be very beneficial as well.
For 10%?
Yes, for 10% increase in the cost of the policy. It's roughly 10%, roughly.
Rodney, have I failed to let you wedge your way in here?
I am never interrupting an attorney when he's talking about attorney stuff. I mean, I'm listening.
That's
Jay was very courteous enough to come over and help train some of our LOAs about title, about cost and how it comes from and where it comes from and all of that stuff. Because it's me and Jay kind of worked together to put the closing disclosure together. So basically we were talking about some of the similar items. But knowing we had some of the same discussion, and just to jump in on like the lender's policy, when we're talking, me and Jay's just having a conversation. To me, it doesn't ever make sense for a buyer not to get that policy when the majority of it's already paid, right? Not to get because, okay, you get the policy knowing it's good then, or somebody's closing, and you can correct me there, Jay. Like if you don't get the lender's policy, if the buyer doesn't take the lender's policy, then he doesn't get the buyer doesn't get that insurance policy at all. It's just saying, it's just giving enough for the lender to say, hey, we're good to go ahead and close on it because we feel good about it or whatever. And then, or I guess we have an insurance policy, but they don't, the customer don't. So I never to me, it's never a good situation where the majority of that fee's paid and then the buyer doesn't, even if they have to pay it and get it.
Right. Yeah. That loan policy, even if you think, oh, well, the lender's getting one, it's fine. That lender's policy does only cover the lender as the insured. And as I mentioned to you, really only ever kicks in if the lender has to foreclose and then the lender becomes the owner of the property, because that's when they're going to actually suffer a loss or if somebody doesn't own the property. So it's once they're in default or foreclosure is when that usually would kick in. So, and at that point, the buyer's already kind of out of luck.
So I'm going to say you guys were busy in the early 10s, right? Yeah. Back in the day.
Yes, there were.
So we have a question here from Angie. What do you suggest for someone buying a house in cash?
So you can get the owner's title insurance policy. They don't have to be issued with the loan policy. And I mean, it's, when you think about it, and I did run a couple numbers just before we got on, just so I could have them as a ballpark. But one thing you realize, if you're paying $500,000 for this piece of property in Davidson, Williamson, Rutherford County. So when I'm quoting title insurance, I'm going to use those counties. And title insurance is kind of county specific, state specific. So wherever you are, you'll want to check these numbers because they do vary all across the country based on risk rates and everything like that. But, a $500,000 property in Davidson, Williamson, Rutherford County, you're looking at $2,900 for a title insurance policy that's ensuring that $500,000 you're spending is going to be there. We've had instances recently in our area of fraud with sellers.
Really?
We've seen it a lot with vacant land where there's somebody finds a piece of vacant land that's owned free and clear, and so they impersonate the seller, have their own notarize the documents, get it recorded, and then the buyer's out. So if they had the title insurance policy, that covers and protects that type of fraud. Whereas if you just wire $500,000 to someone and you get a deed, but if it's not a valid deed, then you've got no recourse other than to try and find where that money went, and usually it's somewhere in a foreign country by that point. So,
God, man, that's,
Yeah.
that's like we hear about those phishing scams with money transfers. I can't think of
Correct.
the word, but they'll end
wire
up
fraud,
wiring it
yeah.
someplace. Yeah.
Yeah.
Golly. Dang.
Yeah, I mean,
there's
it's rampant. It's happening all the time.
Our industry, unfortunately, just with the dollar amount that's being thrown around and everything, it's ripe for fraud. So they are definitely out there because they just need to be successful, one time, and then you get a pretty big payday. So,
are you well, okay. So anyway, the reason we're talking about title insurance up front is to show everybody, and like we know that we get a lot of views after the fact. That's because it's the middle of the day. A lot of people are working, but we got a lot of views after we do. It's called replays. My question or my comment on this is, we're explaining what title insurance is, how it covers it, how it protects us. But then to get back to the affordability thing, Fannie, there's some government entities trying to minimize the cost of buying a house. And one of the things they're coming at is title insurance. And so I was like, wait a minute. That's like you're going out and you're going to buy a $50,000 car it's overly, it's too expensive to buy. But what you're going to do is lessen the price of the windshield washer fluid, and that's going to help you buy that $50,000 car. That's the way it looks to me. But what their idea is to, instead of using title insurance, use an attorney opinion letter. Is that correct? That is correct. An AOL.
Correct.
Yes. That reminds me, back in the day, there were a lot of realtors not making a living, but starving to death back during the crash times when where there was so much foreclosure going on. We had things called BPOs, broker price opinions. And you get like $50 and you'd comp houses and all that kind of stuff. Is that along the lines of what an AOL is?
It's so I've heard about them. They've been around. Typically, lenders weren't allowed to accept them at all. They had to have a title insurance policy, and I do believe Fannie kind of changed the rules a little while ago to start allowing them. And it's similar to what you were referencing, but from what I can gather, there's a lot of requirements that have to be in the letter and a lot of requirements on what properties qualify. There's an attorney in Cincinnati that I think has started doing these for a few lenders. It hasn't really caught on nationwide and hasn't really grown yet. because there's a lot of uncertainty on how they're going to work, and ultimately what plays out when there is an issue, and lenders are kind of hesitant to go down that road, because the title insurance industry is so regulated, and it's been around for a long time now, and there's certain standards that are put in place so people know how that system's going to work. Whereas the attorney opinion letter, I guess if you want, I can kind of get into what that is. And
yeah, I'd like that.
So an attorney opinion letter is where an attorney reviews the title work. They look at the search, they look at the documents, and then they give their opinion on who owns the property, what liens are out there. So they can serve as a tool of here's what you have. So if you have a letter from an attorney, and this is their opinion that this person owns it, they have the right to sell it to you. These are what need to be paid off, taxes have been paid, that sort of thing. It does lay out that, which the title insurance policy does as well. But kind of, to me, the big thing where they vary from is the attorney opinion letter is the attorney's opinion of what they've reviewed. The title insurance policy is an insurance product that is, like I said, highly regulated and backs that search, and backs that title insurance. And I actually just totally randomly, after you reached out to me, listened to a podcast last night about, and they were talking about title insurance. And title insurance started back in 1868 when attorney opinion letters were more common. But there was a case in Philadelphia where an attorney had drafted an attorney opinion letter. There was a lien on title that wound up being valid and was enforced, and the owner of the property sued on that title opinion letter that the attorney missed it. And the court ruled that, while yes, the attorney missed that this lien was valid, the attorney had a valid opinion that the lien was no longer valid, which is why he left it off. So the owner of the property lost the case and then was just out that property. So that's where title insurance started. And it came out of that. So then the industry formed after that case.
Isn't there an old joke about opinions being like something? And it's yeah.
So, and that's the risk, because it's an attorney opinion letter and it's not an insurance product. So when you do have an issue come up, there's a title insurance policy is either the title insurance company is going to pay that lien off, or if it's a situation where it's a forgery, and so someone forged a deed and you're not going to own that property, they'll premium amount, or they may be able to be in a situation where they buy the property from that owner and then you still own the property. They reach some kind of settlement with whoever needs to sign the deed.
It sounds to me like an AOL is a little bit like a pre-qualification letter.
Kind of
casual.
And the article mentioned it too. It's how few claims are made on a title policy. The claim rate's really low.
Right.
But part of that is we, as a title company or whoever's doing it, the underwriter, they're reviewing all the title work so that there's no claim that winds up having to be made. So we're trying to put ourselves in a position that we're comfortable issuing this guarantee.
Right.
And so that's why the claim rate is low. Whereas when you buy car insurance, they're trying to predict what's going to happen in the future, or health insurance, so we're trying to look at the past and then make sure everything is in order to issue that policy. So that our goal is you would never have to make a claim on it, but it's there if you do. And there are certain things that when you do search a property, you may just miss, not because you're not doing or researching it, but there may be fraud with a deed, or if there's an estate, fraud with an heir, that they've cut out a brother or sister that really exist, but all these affidavits are recorded saying they don't exist. So there's certain things that even when you search and look at title can still come up down the road. So.
All right.
Andy, I
yes.
just want to jump in. The attorney opinion letter is really for the lender. It's really for the lender to try to get comfortable with a property, right? It's, again, this is the problem I have with is totally cutting out the buyers. If you go this way, the buyer does not have any, to my knowledge, unless they go and say, I want to buy a full title policy, then they have no option of getting that lender's policy for the price they get it at.
Right there, and I could be wrong because these are still kind of new in the way that, I mean, they're old, but they're new again. I think the attorney opinion letters are usually written to the lender as the client. So as the owner, you would need to get your own attorney's opinion letter that's looking out for your interest. Said it's not an insurance product, so if there is something that comes up, then you're having to go back to that attorney for a remedy or sue that attorney for some kind of negligence or breach to get whatever taken care of.
Now, and Angie asked this question. I popped it up a minute ago. I'm sorry about that. And I answered, I think correctly, but what would your answer be?
Yes, it is. It's a one-time payment. So at closing you make it, and then the other thing too is and then markets very, very country with this, but a lot of times the seller can pay title insurance or is paying title insurance already. So for buyers, it's not really impacting their cost to close if the seller's paying for that.
This could be this is a good question here.
Yeah, it's a percent of title insurance. Yeah. The exact percentage of being wrong. Hey,
Jay, I know you're an attorney, but while you're on this podcast, we can say whatever we want with no, we just try to make it's our opinion. It's the dollars and cents opinion. So you don't have to be perfect on it.
Yeah. It's that they're wrong. It is low. I think it is a single digit percentage amount. And like I said, in that number though, it's, there are sometimes things do get missed. Sometimes people, the property taxes from 2 years ago might be missed, in the search, or, a document might be missed, but a lot of times it is something that's, either when there is something wrong, it's at closing, something doesn't get released properly. Maybe the seller's old mortgage, the bank, when they send the release to the county, either it gets lost in the mail and doesn't get recorded, or they type the wrong book and page number, and so it doesn't get indexed properly. So some of that kind of stuff comes up. So it's not just human error in the actual search process, which it does happen, but that it is pretty rare that happens. But you have some other stuff that even missed. I know there was a few years back, the county had incorrectly indexed a mortgage on a property. And so the way, when you search property, you're searching the index. So we don't have to, when the searcher's going down there, the searcher's not looking at every single deed, every single mortgage, every single lien that's filed. They're searching an index for, okay, who owns this property? Okay, let me search their name. And this mortgage, the county had typed in the name wrong of the borrower. And so when you search for that mortgage, it didn't saw that mortgage. So no one was ever on notice that mortgage existed, but it was there. The bank did record it properly. It was just the county typed it in wrong. And I do believe the title insurance policy wound up covering that mortgage.
And so what you're saying, pardon me, that great lengths are taken to make sure that these things are clear. So, I mean,
right.
It seems to me, and if I'm not mistaken, according to the article, title insurance has been reduced by 7.8% over since 2004. I mean, the policy rates have gone down. So is there a, how much is, and this is the last question I'll ask about this. That was probably a lie. How much is Fannie Mae expecting somebody to save in the purchase of a home by going with AOL instead of
that
$1,000, $1,500?
You know, it could be, I mean, maybe $1,000, $1,500 on a $500,000 property, a little bit more on a larger property. I mean, that's where, when you get up in the higher purchase price, you know, the title policy premium goes up, but then you're usually, you know, you've got a lot bigger risk at that point for that as well. And so I don't think, you know, on $1 million home purchase, saving $2,000 on title insurance is probably going to make or break the deal. But
especially when
it's just an area. I think it's probably the real solutions are really hard, and so they're just looking for different ways they can, well, we lowered this fee or we lowered that fee, but it's not making a big difference in the long run.
And especially when these days, with the way the market is, the seller is going to be covering the title insurance anyway. Right. So I mean,
right. Typically, in that,
it kind of strikes me as funny. And the way that this article is leaning, it's saying that this is a crazy type of solution. You know, it's not sustainable. I mean,
it just, I don't. I
was going to say,
I think you said it right.
Go ahead.
The recent research shows that title settlement fees account for less than 1% of borrowers' total life of loan cost. Less than 1%. And then, but the problem is that setting any kind of risk taken by the banks or the, an attorney opinion letter is a risk for not just the. So yeah,
it's a terrible risk, and it's the only thing. And we'll move on to the next topic. And Jay, you're welcome. I'd love it if you'd stay as we move on. But the thing that kind of causes me to pause a little bit is that somebody somewhere in the government machinery in that Fannie Mae setup has said, "Hey, I have an idea. Let's slice the title policy cost and call it more affordable."
Well, it is, Andy. Now that's technically true. You could slide, and it would cut costs. It's just not it's just looks like a dumb thing to do versus a good idea.
Speaking of Jay, thank you for that. And
You're welcome.
I like what I learned about the enhanced policy. I like that. The final note on title companies for me is, as important as the title insurance is, what I rely on with title companies is somebody that balances all of the numbers so that all the numbers make sense. Between you and the lenders, that's a lot of number balancing going on.
It is. You go back and forth all the time.
It's great. Thank you for that. On to the next topic. Let's talk about the idea that there's a new real estate opportunity brewing as some Americans opt to rent. I thought that this just dovetailed right into the affordability thing. Not perfectly, because that assumes it's a good thing. It's not. But one thing leads to another. The Post brothers, whoever they are, CEO and co-founder of the discussed real estate opportunity brewing in the urban areas as some Americans are opting to rent instead of buying a home. Have you heard anybody talk about that at all? You guys? Kind of quiet. It's Grant Cardone. Are you familiar with Grant Cardone?
Yes.
Yeah, he's kind of a loud guy. and he was talking about people renting. And the idea is the biggest issue, especially in large established metro areas, is a lack of product. There's no such thing as a starter home in large areas anymore. No such, that's kind of the case, isn't it?
Yeah, that's what I the not is, especially, properties for Airbnbs, or, some big $2, $3, $4, $5 million homes. And yeah, you don't see the starter homes being built, by the builders like you used to.
So let me ask you this about this topic. For those people, and it has been happening, that there's been people putting off buying a home for a while. For those that are delaying a purchase on a home, at what age or life stage would you ideally want to transition from renting a home back into home ownership? I mean, for when people are holding off, what do you think? And this is just a question. What are they waiting on? Finances to get better? Houses to get cheaper? What do you guys think?
Jay, I'll let you. I'm on here all the time.
All right.
I'll let you jump in here on this one.
I think it's. I think when rates were low and home prices are going up, I'd always hear people say, "Well, home prices have gone up so much, I'm going to wait for them to come back down." Now that rates are up, people are like, "Well, I'm going to wait for rates to come back down." And from my perspective, just seeing. The inventory just continues to kind of be constrained, and it just, unless we see some big change that causes a big influx of supply to hit the market, I just don't see prices coming down much at all, if any. And so it just seems like, you kind of have to bite the bullet and get what works for you and what fits now. And then, because the longer you've waited so far over the last 5 years, it's just gotten more and more expensive over time.
And the idea that home prices are going to be going down anytime soon. I mean, I've got some slides here ready to go, but the idea that's going to happen seems. Where would on what planet would that happen at this point?
Yeah, I don't know. You do have. Because a lot of people that are already in their homes right now are at a low interest rate or own the homes free and clear. So to them, they're not in it. They're not looking to sell right now, because they just want to keep their rate and don't want to get. So that's keeping the supply a lot tighter on the market. So yeah, you're right. Without something big, just changing the supply, the prices just aren't, because people just don't have to get out of them.
Yeah. And 10 years ago is 29 years of age. Now it's 33. But they also have renters, and this is this other company talking about forever renters, kind of teaching people that they're indoctrinating people into this rent mentality, in my opinion. And they're saying they've got renters at 35 to 45 years old, make it over $150,000. I mean, I think you'd probably be okay buying a house at that point.
Yeah, should be in good shape at that point.
The rents that they're talking about is $4,000. The rent could range from $4,000 to $8,000. Not arguing it's not inexpensive, but on the favorable end compared to the cost of owning a home. What?
Yeah. I know. I've seen some of this
for several years. We've just seen a lot of people building apartments because they can find the land to do so. Right? You can find the land to build a high-rise apartment, or a condo or whatever like this, and call them apartments. But the individual person can't go out and do that, like in the inner city and in Franklin and the cities they want to live. So if they want to live in those cities, they have to live in those apartments. So it's kind of expected because the housing prices. Look at the rent. As soon as the housing prices have kind of skyrocketed, the rates have went up on top of that back to back. The influx, like this area, the influx is out of towners coming in and buying up existing inventory. That's what's fueled our. I mean, where else are they supposed to go? Like, hated this surge in rentals that, but the majority of them's going to get sick of renting just like we all did when we rented. We're like, I'm sick of neighbors walking on top of me with dogs around me or whatever. And you won't, get in a position where you probably need a house. So, that's just, I think it's just part of it. It's just in this last cycle, it's created more renters.
It has. And to finish up that article, and we'll move on to the local thing, which it really puts a nice bow on. It really does. Is the biggest part of the story that these guys are talking about, the forever rental guys, with the millennial generation, which we know that's a big group of people that are coming, would get involved in the housing industry, has come of an age and an income level where in previous generations, they would have been moving to the suburbs and buying houses, which is absolutely true. But this group, they're not doing it. I mean, I was talking to a millennial the other day, and they said, and I don't know that it's an accurate representation, but they said we sort of got cheated. Well, maybe, it's just timing. I don't know. Is that being cheated? I don't know, but it probably feels that way, because people 10 years ago were buying houses when they're 26-year-old easy, and now that doesn't seem to be going on. That's tough.
Yeah, I just especially, and I'm not, I'm not, but I'm looking like around here. It went from where you could buy something to where you can't pretty quick. And I think that's what's pushing that 7-year period for this, the Xers, whoever it is, I'm not sure which generation. It's like, that's a market condition versus a kind of a generation condition, in my opinion, because it's the market's created this. You might be calling if rates were still 3% and new homes are available everywhere and these people, this generation might be the most new home buyers ever. You know what I'm saying? As far as any generation, but the market's not going to allow that.
Angie makes a good point here in this, but I have not a rebuttal, but a comment. In Europe, it's actually very common to rent your whole life. And I don't know anything about Europe except to say there was an article I read a couple of weeks ago, the difference between the United States and Europe in terms of home loans and stuff like that is the 30-year loan. Do you know that to be true? I mean, that's like a game changer for people in this country. Is the 30-year loan versus...
I don't know. I don't know if that's something that doesn't exist in Europe, but I feel like I may have heard that before. And yeah, it's when you can stretch that out and get that payment more affordable. I mean, that's what it is. I mean, I feel like a few years ago they were mortgage, but I don't think it ever caught on to try and stretch it out. But I've heard, I think like in England, it's very much like a rental country, but I think that's kind of the cost, because the cost of homes there is so expensive that in order to live somewhere you have to rent, because it's just gotten so expensive. So
isn't that a harbinger?
Yeah, I mean, that could be.
Wait a minute.
I mean, I seen somewhere the other day I could buy a plot of land for like $25 and I'd become a sir. I mean, it can't be that scarce out there.
I'm sure. Yeah.
When you get that $25, I own something in Scotland and I'm a Sir Rodney.
I like it. Go buy it and at least get the title.
Yeah.
You'd be able to put that in your email signature block. Sir Rodney Wilds.
That's right.
So on to put a bow on this thing. We're talking about forever renters. We're talking about affordability. We're talking about lame efforts to make houses more affordable with the assault on the title company idea. That's, I mean, what's next, you know? I thought that it's not funny.
Realtor fees.
That's what's next, baby. That's on the chopping block even as we speak. But so we got East Bank coming up in Nashville. That's a big thing where it's going to be a nice development over where the stadium is, right?
Right.
Now, what's that area just south of the stadium that I see when I'm driving by on the highway?
Is it the metal company that's there?
Yeah.
Yeah.
It's sort of isn't that a garbage dump? I think it is, but
Yeah.
I don't know. I could be wrong. I looked at it on Google Maps today. That is a big chunk of dirt.
It is.
It is. That's a lot of, and I guess they use the river to transport the stuff. Anyway, so we're going to do East Bank over there. I think it's like 30 acres. But here's what they're promoting on this, in this article about East Bank. And I think, I'm just going to say this out loud. I think there's a little virtue signaling going on. I think that's what's really going on partially with this thing. It says sky-high rent prices have more and more Nashvillians urging city leaders for more affordable housing. My first question is, does affordable housing qualify for buying a house so that it's able to purchase a home, or is it affordable rents?
I'll jump in on this. I'll see what Jay says. When the city in the past has called these affordable units, they truly mean affordable units. Mm-hmm. Like when my past experience, when we're doing some condos and they had what's called affordable units in them in the downtown area. And say there was 300 condos and the city said, well, we'll give you a tax break if you do, 30 affordable units in there, mm-hmm. in the whole complex or whatever. So the affordable units are sold at a significant discount to the exact same thing next to them, like in the same whatever, same floor, same view, same amenities, everything. So it may be let's just say it's half price. Okay. Wow. And the builder agrees to sell them at half price because I guess it works in their numbers that they can do so. And there's also restrictions on them, which the next buyer affordability requirements to be able to buy that property, meaning they can't make more than a certain amount and things like that.
Right.
So when they say there's 300 and 400 units down there with affordables, that actually is, in my opinion, would give a lot of access, that many number of houses to access to people with the same house, but with a price tag.
No kidding. So you've seen. Okay, I won't test you if you say that's what you've been your experience.
Jay's probably closed some of them.
I haven't seen any recent. Yeah, they were like 10 or 12 years ago. There were several of those that were being built in downtown Nashville that had some of those restrictions, and they are actual deed restrictions. So the builder has to sell it to somebody that qualifies, and then, whether it's like a 5-year period or a 10-year period, the seller, or once you buy it, if you want to go resell it, you're under those same resale restrictions. So you would have to resell it to someone that qualifies. With there's ranges of income. They'll do like average median income or something of Davidson County, something like that. But that'll be an actual restriction. So when we do the search, we'll see that. And then the new buyer has to get approved for that affordable unit. So.
Well, and these are, if that's the case, and, call me the creep for maybe thinking it's virtue signaling a little bit, but, sometimes it takes a lot to get things to go through council without wrapping,
Well, when they say affordable units and you don't know, like if you haven't had the experience of knowing that it has a deed restriction and people with a certain amount of income and how they're sold and things like that, they just say affordable, like it says affordable units, but who in the world knows what that is unless you're the lender and the title attorney right here. I mean, but if they're truly
That's a really
affordable,
good point.
where they have deed restrictions, then they are affordable. But when people say, but every advertisement says we're going to build affordable housing, but I think they mean that their affordable is that it's going to be under 4 million or something. So the affordable I'm speaking of and Jay speaking of is actually, I thought is a good thing, because the developers must be getting a deal to where they're getting this land, they're building it, and they're being able to provide us, to the community there. So
yeah. So what they're saying that they're going to include in this, I think it's 30 acres, which it has a little bit of everything. I got pictures, but I won't bring it up. But the proposal expects these housing goals, 300 housing units that are 100% affordable within 2 years. So they're going to be kind of first. Then 400 additional units that are 10% affordable within 6 years. Does that mean 40 additional? Is that the way you read that?
Yeah, within 2 years, we're going to have 300 units
Yeah.
that have deed restrictions. And in 6 years, they're going to have another 40 units out of the next 400. And then another 55 within 9 years, something like that. I don't know if like 5 and 6 add together, or like, if it's like
right.
Once you get to 40 and you got another 15 to go or whatever. But after the first 300, they don't have to build, but looks like maybe another 100 out of the next 1,000.
Yeah, and then the one catch it says, and this threw me off because it was like, geez, who's doing this? Once the James Robertson Parkway is lowered to add more space for a building, an additional 300 units are 100% affordable. So they're kind of putting a catch, there's a little catch there, if you let us lower the thing, we'll build a house for more affordable. I don't know. There's a little packaging going on. But that's fine.
I would rather see this. I'd much rather see this than them say every single property in Davidson County can build a duplex out back.
Man, hit it right on the head. That's exactly right. But they're going to try to do that too. You watch.
There's some areas that could do that, and it would be sustainable, and it'd be an area for that. But it's just county-wide is what I'm mostly concerned about.
Yeah, at least I think probably the bottom line is it's going to be nice, and I've seen pictures, renderings of it. That it's going to be really nice. And I mentioned the junk pile a little bit laughingly because a new place is going up. At least it's going up. They can deal with it.
That's been the place you take every piece of steel the whole time I've been, for the last 50 years I've been in Nashville. So that place, you're talking about the junkyard downtown? The
I
steel
am.
place?
Yeah. I guess
it's not going away, right?
I think of how nice it could be if it did. You imagine if they developed that? Holy shnikes, that would be nice. I noticed
that
stuff
in that.
Sorry, the internet's a little sketchy today, but we'll end it up this way because we've kind of made it home. And I thank you both very much for putting up with a little bit of internet jimpiness today. But clearly, you can tell that the city leaders, the people who are talking about this East Bank development, they've been in communication with their lawyers. I love lawyers, with all due respect. But he said to include this. Remember this thought. He said, city leaders said it's important to keep in mind plans could change before they reach an agreement with the development or the developer, possibly in late February. That time's passed, seems like. It could be the number of housing residential units, the number of hotels, what kind of uses on the other development parcels will be there, that kind of thing. In other words, they're giving 300, 400, 500. We'll see. Things can change. That's okay. That's all right. It's good.
And those always change. I mean, when you
Absolutely.
start going through those, like I remember when going through some of those condos, there's some electrical issues they were building, and it took out, the number of units always seemed to change, a little bit. So
Absolutely. I mean, it's always adjustable. I mean, it's like trying to build a house. It's even when you have plans, things change, I mean, it's just things are flexible like that. Well, I can't thank you, but Jay, especially thank you for joining Rodney and I today. That took a chunk out of your day.
Thank you.
Again, Jay Alexander with Chapman and Rosenthal and Rodney Wilds with First Trust. Do you have any, have we left any questions hanging out there? Philip broke through the fourth wall, so he's communicating with us again. Rodney the Knight, we saw that. Go duplexes. Oh, he's... Oh, okay. All right. We got a duplex fan. Here we go. Oh, I like it. Philip is back. Hi, Philip. Hey, Wendy.
Philip, my HOA would barbecue. Man, I'm telling you what, I thought I was going to get some bodyguards when I first moved in out there. We have come to an agreement to leave each other alone.
Perfect. Perfect. Hey, Angie, thank you very much for being here. It's been fun. I hope I think I missed one of your questions there. I'm sorry about that. Any final thoughts there, Jay?
No. I mean, I think you guys are on track, and I think with the affordability piece, the title insurance is not going to make or break it one way or another. So it just seems like trying to grab at something. So,
yeah,
but thank you for having me on to talk about it.
You're welcome. Rodney, any final thoughts, sir?
No, I'll add in a plug for Jay. In Tennessee, I don't think any title companies are required to have an attorney, but at Jay's office, everybody's that closes loans are attorneys. So they have a staff full of attorneys, not one attorney on staff. Or that's like a lot of title companies may have one attorney on staff. A lot of title companies have zero attorneys on staff. Jay's company is all attorneys on staff. I mean, they got several attorneys there, and they close your loans and answer your questions and just do a great job for you.
They do a great job. Been 10, 11 years now. I love both of you guys. You're great. All right. So thanks, everybody, for being here. Thanks, Ange. Thanks, Philip. Say hi to Wendy for us. We'll see you all next week. Here we go.